Good evening and welcome to our house hunting and hacking group, where we unlock the power of real estate together. We meet on the second and fourth Tuesdays at 7 p.m. Mountain Time. And we are so excited to have all of you here. And I'm going to actually introduce my fellow admins that are in the midst of traveling right now, but hopefully might be able to tap in and join us later in this meeting. So I'm Genevieve Henderson, the loan advisor, and John Nichols is our realtor for the group. Amber Zamudio is our insurance specialist. And together we make up the house hunting and hacking admins. We do rotate, and then occasionally we love to throw in guest speakers, such as Shauna. Shauna Green is our guest speaker this evening, and I'll be moderating the chat box. So if you want to shoot questions through that chat box, and I can try to interrupt Shauna, or Shauna, if you're okay with, live questions coming in.
Oh yeah, that's fine.
And so she's going to be speaking on mastering the infinite banking, unlocking financial freedom. So I'm going to stop sharing so that she can share.
All right, let me get everything situated really quickly. So, okay. So infinite banking, it's super exciting and fun. A lot of people are talking about it this year. Just a little bit about me. I'm Shauna Green. I'm the owner of Front Range Insurance Solutions. If anybody is interested in contacting me afterwards, this QR code, you can save it into your phone and you can keep all of my contact information. I'll have this at the end of the presentation as well. So to begin, so you know a little bit about me and why I actually have some clout in what I'm talking about. I actually grew up in a house hacking home, so I was kind of excited to be asked to this group. My mom was a single mom. That's her down in the bottom corner. We rented out our basement to another single mom with a daughter, and it was really an advantageous situation for both of our families. And I was also raised by my grandpa. If anybody is old time Boulder, Grandpa Rayback owned a plumbing shop that was really well known. It's now the Rayback Collective, and they kept his name in his honor. Grandpa was an owner of 30 properties in Boulder. I grew up helping him remove tenants' debris. We repainted, re-roofed, we plumbed. I finally drew the line when he wanted me to get down into a septic tank with him. There was no way I was doing that. But I learned a lot about rental properties from Grandpa. I learned a lot about hard work. I get some of the things that you guys are going through when you do have renters because of that experience. Next, I have insurance in the blood. My grandfather, Jack Cox, this is him up in the corner. He was a district manager for Farmers Insurance. Then my dad became an agent for Farmers. All of my uncles became agents with Farmers, including my uncle on my mom's side of the family. And I even have a cousin, some of you may know him, Bryce Babcock, that's my cousin. And I broke the family mold when I went independent because I decided that I wanted to have a few more offerings for my clients. I'm able to offer a lot more carriers. This comes in handy with all of my property investor clients just because you guys tend to think outside of the box and I need to have more options for you. So these other options are why you're here tonight. Let's go ahead and start talking about that. First thing I want to go over, I feel like a lot of people that you hear talking about infinite banking, they fail to tell you who this is not for. This isn't for everybody. This is not for those who are seeking to get rich quick. It's not for those who do not have self-control when it comes to money. You need to be good at managing money to be able to have an infinite banking account. So it is really good for property investors. For the most part, you guys are pretty responsible. It's not for those who do not have money to put away. This is for people who can stick to a budget and make payments when they say that they will. This is for those who want to see their money grow more than in just one place. It's for those who want to see the benefit of having a tax-free source during retirement, for those who want to protect their empires from illness or injury, and those who want a solid estate plan. All right, so I talked to a lot of people about money. And I found 3 ways that people typically think. The first way is usually that adventurous way of thinking. They're into real estate, stocks and bonds, commodities. It's all of those things that have a really fast upside potential, and you can equally lose it just as fast, right? But the second is those who are really timid. They want to take their time. They hide their money. They might put it into banks. Literally, I've had a client who had $400,000 stashed in his home. It wasn't as safe as he thought it was going to be because his home burned down and all of that money was just gone. So that's not the best way to go. A lot of us hope that there's something somewhere in between. And that's actually what we're going to talk about tonight, because there is a place where you can find that safety. And at the same time, you can get some of that upside potential. I am your Save Money Girl. All of the products that we'll be talking about tonight are things that you cannot lose money in due to the market. And in order to be able to understand infinite banking, you kind of have to understand how banks work in the first place. So here's your bank. Here you are. You're going, sorry, Jose and Mike, you guys are going to be a little feminine tonight. We're going to pretend that you're going to the bank. You're putting your money in. And now they're going to give you a grand whopping 0.59% return because you are a good client. And then instantly, they're going to bring your money out. They're going to loan it to someone else at maybe 6, 7, or 8%. Now, a lot of people, when you think about this, you think, well, what else could I do? Because we've all been raised with our moms, our grandmas. Everybody always put money in a savings account. Well, we take out the middleman with infinite banking, and all of a sudden, we're now earning the 6, 7, and 8%. That's why so many people are raving about this on social media, right? Just out of curiosity, if you guys don't mind taking your mics off, what have you learned about infinite banking and what made you interested in coming to this tonight?
I don't know anything.
can tell.
Well,
Go
I'm
ahead.
glad you're here.
I can tell you from my point of view as a lender. I know that John Nichols, he's our realtor for this group. I think he has a similar type of product, and it's awesome because working with him as a client and as a real estate investor, it is a huge, ginormous, valuable tool for him because he can use it for down payment. And investment properties, are a hefty amount of investment initially, around 25%. He can use that as a down payment tool, or if he doesn't want to use it in that way, I can use it to help qualify him for the reserve requirement to cover, typically in underwriting guidelines, you have to have a certain number of months, and it can range depending on what the system spits out. But I'm able to use his extra savings in this as reserves to help him qualify for purchasing investment properties.
I love that you added that. That's one of the things that I've seen too, and we'll talk a little bit more about some of the advantages. Major ones that you're hearing about online right now are this list right here. Things like risk management, market-like returns, tax-free growth, tax-free access forever, tax-free wealth transfer. You have control, just like what you were talking about, Jen. You have control of that money. You can actually use it for things. Liquidity, you can take it out before age 59 and a half. You can use it with leverage, tax-free income for life, and legal protection, and more. So what is this golden ticket? It's life insurance. That's super exciting, right? Well, when you know the advantages, it really is. And this is what millionaires have been using for years and years and years, just for things like what you just talked about, Jen. Now, there is an old kind of life insurance and there is a new kind of life insurance. And I want to make sure everybody understands that. The old kind of life insurance only includes a death benefit, whereas the new kind of life insurance will actually protect you should you get sick. You can make a claim with all of these different triggers. I have a couple stories that always stand out in my mind as reasons, a motivation for me to share these with people. The first one's really terrible. We actually have an agent whose ex-husband was very angry at her, and he poured gas on her in a parking lot and lit her on fire. Because she had one of these policies. She was able to pay for all the plastic surgery. She was able to pay for the therapy. And this was a way worse event than it could have been. The second one, we had a client who actually was terminal, and she decided that she didn't want to fight it. And so she was able to take her money out of her death benefit, and she used that money all the way up until the day that she died and just traveled the world. And for me, that's a really beautiful way to go because she had complete control. And I think, as property investors, that's kind of part of the plan, right? We want to have that money so that we can ultimately have control. Now, gee whiz fact, 66.5% of all bankruptcies are caused because of some kind of medical issue. People don't have the preparation that they need for this. You guys are empire builders. It is super important that you are building a layer of protection around that empire, and living benefits within these type of policies can provide that kind of layer. Do you guys have any questions about living benefits? All right. So infinite banking. This is the part that you guys all wanted to know about. Here are the benefits again. A lot of times when you're on social media, you are going to hear a lot of fluff. You're going to hear things like, the one thing that I think is, I actually made sure that I did not have it in my presentation, is when people say things are risk-free, right? Nothing's risk-free. The biggest risk within these policies is you. If you're not going to pay your premium, then your policy eventually will expire. Other than that, though, these are pretty good and safe. And the way that these work with infinite banking in particular, is that you are going to have two piles of money. One is going to be your money. The other is going to be the insurance company's money, and that's in reserve. One of the things that is really beautiful about the way that the system works is that you have an insurance company that has dollar for dollar and then more. I don't know if you realize this, but back in 2020, the banks actually no longer had to have regulations making it so that they had to have money for your money. That was completely extinguished. Now they don't have to have anything. Whereas insurance companies are highly regulated. They have to have at least $1.10 to every dollar that you have in there. One of my favorite carriers that I work with actually carries more than $4 per dollar. And so you have a lot of safety in this kind of situation. Now, why is that important? Well, if you're serious about being in this infinite banking situation, you need to understand that there is that safety. And then you also need to understand why. Back in 2008, you had 400 banks that collapsed. You had 900 banks that were on the brink. And the US government went and polled the top few banks in the country, and they found that they were all invested in something called BOLI. That's bank-owned life insurance. You can see here in the bottom right-hand corner, this is Bank of America. That's a pretty big chunk of change. They have that invested in life insurance. And that's one of the things that helped them stay afloat. It's a very big part of it. Next, as you keep your money in the banks, we have this issue of inflation that we're dealing with. This year, our inflation this month is actually at 3.09%. I looked it up today. And, that's not bad, but well, Jen, you probably know, and Tiffany, I'm sure that you guys both were on the radar for this one when our interest rate rose up to 9.1%. As we had our money sitting in the banks and we were receiving that 0.59%, we were literally losing money as we were trying to save it. All right. So the way that infinite banking works and the way that we have this risk management that keeps our money growing with market-like performance, while at the same time keeping it safe, is that we have a floor right here. This is the zero is your hero floor. You heard that a lot online. And that means that your money cannot go any further than zero anymore. You'll always keep the same amount. But in order to make this work financially for the insurance company, you're also going to have a ceiling. Some of this upside potential is going to be taken. It's going to go off to the insurance company. They're going to go and invest it in double, AAA bonds, long-term solid investments, which then allows us to sit and play here in the safety zone. I don't know how many of you remember 2008. I had a best friend whose father lost half of his retirement almost overnight. It took him decades to regain that. Had he had one of the policies that we're talking about tonight, his money would have stayed level. If he had 500,000 in his account, he would have had 500,000 the next day. And then when the market went back up again, he'd just keep growing. And then it keeps going kind of like a staircase instead of this crazy roller coaster. This is usually where I get a lot of questions. Does anybody have questions about this part? No?
Yeah, what do you mean by like that floor, that it can't go below that? I get at the top, but I'm unsure as to the floor. Like, so are you saying like if I put $500,000 into that account, it will not get lost?
That's 100% correct. That's exactly what I'm saying. It works a lot like a ratchet wrench, where it will click, 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 and then lock into place. And then the next year it's released and it click, 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 clicks and locks into place. And it will never drop. It will always stay level or it will climb up. Those are the only options with these accounts. That's a pretty phenomenal aspect to them. All right. So next, we get to talk about everybody's favorite subject, right? Taxes. But in this situation, this actually ends up being one of our favorites. My grandpa, the property investor, he would actually borrow our neighbor's goats so that we could then get the grazing tax discount. And so I know all of you guys are looking for those different avenues that will allow you to keep more of that money. Well, with this, you're allowed tax-free growth, tax-free access forever, tax-free wealth transfer. And this is all due to tax codes. It's actually protected by something called TEFRA, DEFRA, and TAMRA. And those are rules. If you guys want to write these down, you can check them out, make sure that I'm legitimate. But there's tax code 101A, tax code 72E, 7702. Those are the three main tax codes that you want to make sure that you are paying attention to, because it really is just saying all of this can be tax-free. You can grow your money tax-free. You can give your money away tax-free at death. And you can use it in retirement tax-free. Why is that important? I don't know if you guys are familiar with this. This is the national debt clock, and it grows every single second. I had checked this just a couple of months ago. It's down to 31. Now it's up to 34. It's crazy how fast this is growing. We have this aspect, and then we also can look at historical tax rates, right? I don't know if you guys know this, but in 1944 to 1945, the highest tax bracket was up at 94%. How's that make you guys feel? Not too exciting, right? So it's really important that we're looking for some type of tax-free avenue, not just for retirement, but just for safety factor, because we don't know what the future holds. It could be higher, depending on who is called into office next. It could be lower, who knows? But the next benefit that we get from these is liquidity. How many of you guys have some kind of retirement plan already? You have a 401k, an IRA, Roth. All right, so for those of you who do, you're familiar with some of the laws. If you take money out before you're 59 and a half years old, you are going to incur a 10% fee, and you're going to have to pay the taxes. One of the beautiful things about infinite banking systems is that you can actually keep the money in for as long as you want. I have a client who's 72 years old, and we were talking about these accounts. He was irate because he had an IRA that he had a whole bunch of money in, and he didn't want to take it out. He had made a good income, wanted to leave it there so that when he passed away, his family could inherit it. Well, that wasn't possible, because at 72, you have to take out required minimum distributions, or you get to pay a 50% excise tax, which is pretty crazy. With these, you can just leave it. You can let it grow and grow and grow. The other benefit that you can have, Jen, you were talking about how John uses this, you can literally just fill out a very simple form, turn it in on Monday. You can have your money by Friday. It's very easy, very quick. The next benefit that I think you property investors should specifically pay attention to is that these policies come with a lot of flexibility. One of the things that I see constantly with my fix and flip clients is that sometimes their bids aren't true to what they're written at, right? Weird. They tell you it's going to take you this much to build out your bathroom, and it ends up being a few thousand higher because maybe they found mold or whatever it is, right? Well, in this situation, you don't have to pay your payment the next month if you're using an IUL. Now, if you're using whole life, you're going to be set with payments right away. They're not significant though, but that is one difference. You know, I had another client who ended up finding out, she wasn't with me. This wasn't my policy that I wrote, but she found out that her roof wasn't covered. We had a hailstorm in Colorado, and she ended up having to replace her roof, which really depleted her budget, right? So in this situation, this is a place now where your money is flexible and you have additional funds available if you didn't draw from it already. Okay. Any questions about the flexibility?
Is there a limit to the amount of draws you can take in the
Yes.
specified time?
It's dependent on how much money you have in there and what you're taking out. So, you know, usually you do one loan at a time, but it's all going to be based on what your policy is holding in it. Good question, Mike. Did that answer it?
Yeah, I was just thinking, you know, you pull it out because you need to redo your roof, and then you find a property that you want to put a down payment on. Can you add to that loan amount at that time, or does that first loan have to be paid off before the second one can be taken?
Repeat it because you kind of broke out.
So I got my headphones on at work. So if you take a loan out for, say, repairing your roof, and then you find a property that you want to fund a down payment with, or there's an opportunity, can you modify that loan amount to add that further, or do you have to pay off the first loan before the second loan can be taken?
So that's a question that we'd have to go through individually because it's going to depend on what carrier we're working with. So that's one that we'd have to do personally. We'd have to look at it, but that's a good question. I would like to say yes, but again, it just depends on what carrier you're with and which type of policy you're using too. The one thing that you'll want to consider, it's just like any loan, you're going to have to different APRs that will apply. And you may get one with one part of that loan and one with the other part of that loan because they will be separate. You can't combine them. So there's your answer for that one. I just connected that. All right. So two of the people that have used this and the way that we just talked about were Walt Disney and JCPenney. Walt Disney actually wasn't able to get the funds to build Disneyland. He couldn't get people to loan it to him. And so he took money out of his life insurance policy. And I don't know about you, but I'm pretty glad he did. JCPenney, this is my favorite story like this. It was during the Depression. He didn't have money for payroll. So he took money out of his life insurance policy and he was able to pay payroll. Now, these can work just like an old-fashioned pension plan. I have a client who is 63 years old. We had quoted him a policy with an IUL because he was tired. He had 12 million in assets and he was getting older. His body was not quite what it used to be, and he didn't want to take care of his rental properties anymore. Now, an added I guess, insult to this was that his children weren't interested in having these properties. They were all well off and they didn't want them. So what we did is he took $500,000 worth of properties, he liquidated those, and he was able to put that entire amount into one of these policies and then turn on lifetime income that will come to him every single year. Every single time it comes, all of the money is tax-free. And even after he uses it every single year until he passes away, his children will still receive a small death benefit. I don't know of any other financial instrument that is able to do something like that. It's pretty incredible. And here is another testament of what I just talked about. So it's usually the one that gets the guys pretty excited because it's Jim Harborough. He's the university coach, the head coach for University of Michigan. He negotiated with the University of Michigan to put in $2 million every year for 7 years. And then he's just letting it sit there until he's 66 years old. At that time, when he retires, he'll be able to draw out $1.4 million every single year for the rest of his life. And like I said, he'll still be able to leave a small death benefit for his children. Well, his is probably going to be a pretty large death benefit, but he's also going to be able to do this without market losses. So, any comments or questions on that before I go to the next benefit?
So you've said that this policy can it earns like interest, is that?
It does. Yeah, last year, well, one of the recent reports that I just read from one of my clients, he received a little over 16%. So just depending on the year, there are other clients who've received 18. It just depends on what policy they had, what indexes we chose, and the year. So how the market performs will affect these policies. But you'll never drop. So.
Wow, and so that interest is not taxed.
No, not as long as you use the policy the way that I'm telling you to, and I'll show you exactly how, because these are tax deferred policies, but because we use them the way that we do, everything stays tax free forever, and I'll show you the trick, okay? So first we're going to talk about one other benefit, that is that we have legal protection. In the state of Colorado, you're actually protected for up to $250,000 from creditors, which is a pretty big deal. I have my little medical person here because I worked with a lot of doctors, and malpractice runs rampant, right? So doctors could have a little pocket of cash that would be protected from anybody who pursued legal action against them. All right, so now we get to the details. This is the infinite banking strategy. First, you're going to deposit your funds. It's going to change for permanent life insurance, right? That's the golden ticket that we talked about. And now the excess is going to go into savings. You're going to have your pile of money right here that we talked about. And then you're going to have the life insurance company's policy pile of money. Now, your money is going to act as collateral, okay? And you're going to take a loan out from the insurance company. Their loan rates are always lower. I have never seen it be higher. It could be at some point, but I've never seen it be higher than what mortgage loans are. They're always lower. And you have two ways to do this. You can do this as a zero wash loan, where you're guaranteed to earn the percentage that you would be paying as an APR, and then it's zero. You don't pay anything. Or you can do it as a participating loan. Now, why would you want to do it that way? It's easy. You're going to make some money. Okay. This money, I want you to also remember, is that you're going to continue to grow it at full value because it is not being touched. So that 16% that my client made last year, he would earn it on this full amount, even if he took out that loan, right? Because it's still just sitting there. Now we're going to pretend that we're going to give you $100,000. You're going to put that into your account. Your bucket has $100,000 in it now that you're going to take out through a loan, right? Which means this year we'll say that the APR is 4.5%. So now you're paying $4,500 for this loan for $100,000. You're going to go invest it in your next house hacker project, right? So you're going to, now I just told you we made 16% last year. We're going to pretend that it's 8% this time, okay? Did someone have a question? No, okay. So you're going to go ahead and look for your little project. Right now, you are still continuing to grow interest. You earn 8% on your pile of money on that $100,000. So you have $8,000 minus the APR of $4,500. You've made a profit right here of $3,500 while you're loaning out this money. You go ahead and you buy your little project. This is definitely not in Colorado because you make a return of $15,000 when you decide to sell it. And now you have a grand return of $18,500 from your project and your growing loan money. Does that make sense? Okay, then you're going to stick it back into your bucket and you're going to do this whole process all over again. I have a client who did this. He actually had $300,000 in his bucket. He was able to purchase a home in Texas because he was able to buy it with cash. He got a killer deal and he was able to fix it up, went and sold it. He put it right back in and he's able to do it all over. So it's pretty good. All right, there are a few different kinds of policies that you can do this with. You can do this with whole life. Whole life is better suited for those who are really low risk tolerance. Those people who want to make sure that they're getting something every single year. They don't like to see those 0 years when the market drops. And that's a good way to do it. Universal life, though, gives you a few different options. You can do this with fixed, variable, and indexed. I don't do fixed and variable because these are the accounts that don't have those lock in place features. You will go below 0 and you will lose money. Whereas indexed, you can't because of the way that I showed you. You're playing in that safety zone where you won't go below 0. And then term life insurance, a lot of people get confused and think that that is something that you can use for infinite banking. You cannot because it does not have any kind of cash value within it. Okay, so let's talk about some people that have used this. This is one of my clients, a 38-year-old male. He decided to do it in the most advantageous way that you can do this. Okay, this is called the 5-pay plan. He used it on IUL. One of the features of IULs, they actually have historically performed better. They've outperformed whole life because of that. They have a lot more, they can gain a lot more within a year. All right, now he's 38 years old. He decided that he's going to put in $100,000 for 5 years. Okay, so every year for 5 years, he's paying $100,000. Oops, ignore this $2,000. That was one of the other options he didn't choose. Okay, so now he put in $100,000 in year 1. He can borrow out $92,175 in the first year. Okay, the first year in these policies is your most expensive. But still, that's pretty good. Now, his living benefits that are available and his death benefit is $1,939,284. Believe it or not, we actually dropped the death benefit as much as possible. And the benefit of doing that is that now he's able to have as much cash as possible in this account. At year 6, once he's put in all 5 years of that $100,000, he now has $500,000 in here, and he's grown. He has a return of $28,167 past what he's already put in, right? And I've structured this so that his life insurance is actually growing. The reason that I do this is because it allows so that he can continue to have his life insurance get bigger as his assets are accumulating. You can see he continues to have 500,000. You can see that the money is accruing like crazy, right? By the time that he's 65 and ready to retire, well, I guess he would be 38. Mike, you're the math man, so correct me. He'd be 69, right? He would have 1,607,798 in there. And that's huge. Now, the other thing that I want you to realize, this was illustrated at 5.77%. I just told you last year we had returns of 16%. This is incredibly low, very, very conservative, but it's what we're regulated to show on our illustrations. Now, the next client is a 59-and-a-half-year-old woman. This woman came to me because she had an IRA. She was really not wanting to pay taxes in her retirement. She also just wasn't trusting the banking system anymore, and she wanted to get her money out. So she put in a total of $242,735. That ended up being $48,547 every single year. Again, she did the 5-pay plan because that was the most advantageous for her. Because she's a little bit older, it grows a little bit slower because the life insurance company knows that they're going to be paying this out sooner, right? But you can see that even her death benefit starts to grow by year 31. And this is the money that she's able to borrow out and use for other projects. Now, she intends to do some hard money lending with this money, where she's going to be gaining a percentage there, and she's going to be gaining a percentage in these accounts. And we decided that we would build out 3 accounts for her. because she had two pretty sizable IRAs. And so we split it. And our thinking was that that way she could stagger when she turns these on in retirement. And while she's using one, the other two are continuing to grow compound interest. And then she can turn on the second one, and the third is still growing compound interest. And then she can turn on the third one if she chooses to. Does that make sense? Okay. All right. So this one right here is actually my best friend's baby. We call him Mr. Moneybags because he has $1 million baby account. She decided to put in $250 a month. You can actually start these with less, but she chose $250 because it fit her budget. Now, when this little guy is 18 years old and he's ready to go to college, there will be about $71,914 in here. This money is not like a 529. He can use this if he wants to start a business. He can do his own first flip. He does not have to use it for school. He can use it for whatever he chooses. His death benefit is going to be $489,202. Then when he's ready to buy a home at age 30, he'll have $180,589 in here. I don't know about you guys, but I did not have that kind of help when I was ready to buy a house. That's kind of awesome. So, and then when he's ready to retire, this little guy, this is why I call him Moneybags, he's going to have 1.5 million in here. And if he decides, instead of using this for loans and to be able to invest and whatnot, he can actually turn on that lifetime income that we were talking about. He will receive $99,925 every single year. We chose age 65. He could leave it in there longer and get even more, but that's what we chose. And he'll be able to get that every single year for the rest of his life and still have a death benefit. Any questions about those?
In that scenario, does that mean she's giving $250 a month up until his age of 18 and then she stopped contributing?
No, she'll continue until he's 65, but he is, her plan is to, at some point, go ahead and turn the policy over to him. Now, the other beautiful thing about this is that she's the owner of this policy. And so as this money is growing, she's using this for her investments. She's actually a realtor. And so she has his policy, she has her policy and her other kiddos' policies that she's able to draw from and pay back into, but it's still growing, so that by the time he's old enough to use it and to inherit it, it's going to be ready for him. So, all right. And I think this is my last one. So this one is a 21-year-old female. She actually was a manager over at Burger King, and she had just finished paying off her car. So she decided to use that $350 a month. She put it into an IUL, and at age 30, she will have, after paying $350 a month, she'll have $45,748 that she can start using. And then she has her living benefits of $433,389. At age 45, she'll have $208,000 in here. At age 65, when she is planning to retire, she's going to have $920,546 in here. And she can turn on her lifetime income of $64,438 that will come to her every single year, and it will come tax-free. So, and then she'll also have her death benefit of 1.1 million. Any questions about that?
I have a quick question. Hi, it's Jose.
Yeah.
I'm a little bit confused, at least with how the values are presented, because they don't really account for historical inflation, so they're not all present values or future values. So like, what will be the equivalent of 920K 35 years prior, or vice versa?
That's a good question, and I can actually show you those numbers if you want to go through an illustration with me.
Sure.
That's one reason why we are going to be illustrating at 5.77%, because it gives you the low end of what is possible, because you'll have some years where the stock market is just going to tank, and so you're not going to have any gain. Whereas you're going to have other years where it's just going to perform. I mean, the last 10 years, we had some pretty incredible gain with these policies. And so if you want to see those numbers, I can show you those. Just not now.
Yeah, I guess the only question again, it goes back to, let's say it's a bad year, right? You're saying that there would be zero, you don't lose anything, but money could depreciate. So let's say you still have 100, you stay at 100, but
Mhm.
your 100 loses, I don't know, 8% like it did in 2022. I think that was the inflation.
Mhm.
So your money is worth 8% less, even if it stayed at 100, right?
Yes,
That's what I'm saying
these,
about like,
these policies tend to grow with inflation though. And so it's not going to really, you're really getting into the weeds with this one. It's not the same thing as if it's in a bank account. It's going to be growing significantly with all of the inflation.
oh, okay.
Does that make sense?
Yeah, it does.
Okay. But Jose, if you want to make an appointment, I will definitely show you some of these numbers and we can go through that because that's a good question.
Shauna, is it somehow, if that phenomenon happens where like we've just been going through this situation, so his question is so on point.
Mhm.
In that inflation is high, but what typically happens in a market with high inflation is that the Fed increases the rates on the Fed funds rate. And
Mhm.
because of that, then just like our savings vehicles right now, high yield savings things, our interest rates that we've never seen before, in being able to accumulate a really good return on our savings if you're using any of those vehicles right now. And
Yeah.
that translates to a policy like this. So when you have the high inflation, you also have a good higher savings yield. Is that what happens?
That's correct. Yeah. So it actually works with inflation and which is another layer of our protection, right? Because as money is valued less, this actually increases. So, all right, good questions. Anybody else have more questions? Okay, so then I have some questions for you. Are you guys all clear on who this works for and who it doesn't work for? Like it really is ideal for you property investors. One of the things that it drives me a little bit crazy is when I see online people are just saying that it is for everybody. It's not. It's for good people. It's for people who have good money sense, right? So just want to make that clear. Now, if you wouldn't mind, I actually created a form. I am going to be teaching at a property summit next week, 2 weeks, whenever March 8th is, March 8th through the 10th. It's going to be in Denver. Anybody's invited to go. It's at the Curtis Hotel. It is the Great Mile High Real Estate Investor Summit. And if you guys want to attend, you can. I'm actually going to be teaching there. So if you don't mind, I would love to spend maybe just a few minutes where you could fill out a form for me. Tell me what you did appreciate learning, what stood out to you, and what I might be able to do a little bit better with so that my presentation can be really good. Would that be okay? That would be great. Okay, just a minute. Let me get that for you. I will just put it in the chat. And if you don't mind filling that out for me, I would really appreciate it.
And in the meanwhile, do we have anybody else that has any questions, either for Shauna or anything related, from real estate or a lending standpoint that we can try to help you with?
I have a question on it, and Sean, I know we're going to get together separately. I'm considering selling a couple of properties.
Mm-hmm.
And when I do that, I don't want to do a 1031 exchange. I would like to put the money into a particular account, potentially use it as a large down payment or pay cash later on this year for a different property, but not an investment, most likely not a primary.
Yep.
Could I use this type of account in lieu of a 1031 exchange?
And every property investor asks me that. No, you can't. You have to pay the taxes. So yeah, the government's gotten pretty good. You have to always go like to like. So even within life insurance policies, or when I do rollovers for 401ks or IRAs, we always have to keep money qualified. It's kind of the same thing.
It would be like to like, because one would be an investment, the other would be a primary. It just would be that holding account, so I wouldn't have to go to a
Well, if
1031.
you're doing it within that time period, that's something that we could check into. That is possible. So that's something that we could look into. I will call our advanced market team and find out for sure so that it's all legalized.
Okay.
All right. Any other questions? And I put that form in the chat, by the way, if you guys don't mind filling that out, that would be really helpful for me.
Oh, I'm so disappointed that John and Amber didn't get a chance to join in on this. I think they would have really enjoyed it. With Amber, it's always these different perspectives from this industry. And so we end up, thinking about multiple sides and impacts, especially as it relates to real estate. But yeah, great questions, Tiffany, as well as Jose. Any other questions that you guys have?
All right. Well, so I'll just tell you in closing, one of the things, I actually had a pretty fun experience with a couple of my clients. One is an architect, and I think the other guy is in IT. They're partnering up for fix and flips right now. And so they're both talking to me about these. And we were comparing whole life and we were comparing IUL. And so the last piece of wisdom that I'll leave with you is that if you decide to go deeper into this and you're looking on the internet, remember that one is not better than the other. It just is which one fits your needs. They're both meant for this. They both work really well. And if you go onto the internet, you're going to find haters on both sides telling you that each one is better than the other. And it's really that those agents haven't written both. They don't know both. And both really are good. So there you go.
I'm gonna share my screen here real quick and finish us out for this meeting. So here we have, so this is our closing announcements. Our next meeting is on Tuesday, March the 12th. I'm actually going to be presenting on that one because I've gotten super pumped up about a topic I came across actually working here in the industry of real estate. There is a big upheaval coming with condos. And I've already been experiencing it professionally and seeing other loan officers coming across this. And I want to shed light on it. I think it's really going to change things. So if you know of someone who is currently a condo owner, is thinking about buying a condo, or maybe you're an investor, you definitely want to attend this. If you're a realtor, you would want to attend this, because realtors sell condos, and help buyers buy them. And this information is critical. We actually lost a deal last week.
Is this all the changes that went into place a couple of years ago over the approvals for the condo projects?
It's not about necessarily the common issue that you've been hearing about. Yeah, I mean, ramifications of the condo collapsing in Florida, that's ruined it for all of us. With their strict examination now of deferred maintenance. I think that's probably pointing at. No, this is an addition to that. So this is really huge. Again, killed a deal. And I also saw in the same week, it killed 2 other deals. And so this is changing how I'm approaching condos for my clients, from a buying standpoint. And I think if you extrapolate the ramifications of what this will mean, I mean, this is a lot of negative things, with regard to like home ownership, or buying, but also for investors, this could be major freaking opportunity. And I want to let my realtors know this, my buyers know, I work with a lot of investors as well. And I think it's really important information. So I'm going to go over that in 2 weeks on Tuesday, March the 12th at 7 p.m. And we do have that RSVP on Meetup. I'll be posting that tomorrow. And we have different Zoom links, so be sure, don't think that this Zoom link will work for that one. You'll need to definitely be sure and RSVP and click the separate Zoom link for that event. You can also see that we have a Facebook group that you can check us out, ask questions of real estate. Our realtor, John, for this group is a heavy investor. And so ask away with insurance questions, real estate questions, lending. And then we also, like I said, we're recording this video, and you can find all of our videos that we have recorded, as well as this one, if you like to share it, on our YouTube channel at House Hunting and Hacking. So thank you so much for joining me tonight. And I really look forward. I hope to see you guys in a couple of weeks when I'm presenting. As I said, I think it's going to be a really, really important topic. I've already got a lot of realtors that are interested in coming because it's important information to have to communicate with your clients and also to hop on as an opportunity if you're an investor. So thank you guys. Have a great evening.